So, you've just sold a major asset in Nigeria, maybe a property or some shares, and you've made a nice profit. Great, but that profit might come with a tax bill you weren't expecting. Today, we're going to demystify capital gains tax, and by the end of this, you'll know exactly what it is, how to figure it out, and most importantly, how to legally minimize what you owe. Let's dive right in. You know that moment you've sold a house, cashed in on some stock, maybe even exchanged a bunch of foreign currency, and then that little thought pops into your head, wait a second, do I owe tax on this? If you've ever asked that, you're not alone. The answer is often yes, and that's exactly where capital gains tax, or CGT, comes into play. So what is a capital gain anyway? It's actually way simpler than it sounds. You buy something for one price, later you sell it for a higher price. That difference, right? That profit you just made, that is your capital gain. And that's the specific slice of the pie that the government is interested in. But hold on, this tax isn't for selling your old phone or your used car on the side of the road. No, it only applies to something the law calls a chargeable asset. So the first big piece of the puzzle we have to figure out is, what exactly counts? Well, the net here is cast incredibly wide. We're talking about pretty much all forms of property. And here's a really important point that a lot of people miss. It doesn't matter if that property is in Lagos or if it's in London. If you're a Nigerian taxpayer, the rules apply, period. It's a global thing. And we're not just talking about physical things like buildings or land. The definition also covers financial instruments like options and even foreign currency. It also includes intangible assets, things you can't really touch but are super valuable, like trademarks, copyrights, and patents. Okay, so you've sold a chargeable asset, and you've definitely made a profit. Now for the really important part. How do you actually calculate the tax you owe? The good news is you don't need to be a math genius. It's just a simple step-by-step formula. Here's the basic logic. Let's just walk through it. First, you take the total amount you sold the asset for. From that, you get to subtract any allowable expenses you had from the sale. We'll talk about what those are in a second. What's left is your net sales proceeds. Then you subtract what you originally paid for the asset in the first place. And boom, the number you're left with is your chargeable gain. That is the key number. All right, so you've got your chargeable gain. What now? Well, this is where it gets refreshingly simple. Unlike income tax, which has all these different brackets and percentages, capital gains tax in Nigeria is just a flat 10%. That's it. No complicated tables to look up, just 10% of your gain, that's the tax you owe. Now, theory is one thing, but seeing it in action makes it all click. So let's make this real. We're going to run through a perfect example, a guy named Mr. Eubank who just sold his house. Let's see how the formula works for him. Okay, here's the scenario. Mr. Eubank sells his house for a cool 14.5 million naira. Now, your first instinct might be to think the tax applies to that whole amount, but that's not right. We've got to factor in every single legitimate cost he had, from the day he bought it to the day he sold it. Let's just follow the money here. He starts with 14.5 million from the sale. Right off the top, we deduct the costs of selling the house. That's the agent's fee and advertising. That's over 1.5 million he gets to subtract right away. Now we're down to his net proceeds. Next, and this is the big one, we subtract his total cost of acquiring and improving the place. That's the original price he paid plus what he spent on renovations. After all that, his actual profit, his chargeable gain, is a lot lower, just over 5.1 million naira. And now for the last super simple step. We take that 5.122 million naira gain and we apply our flat 10% tax rate. So the final tax Mr. Eubank actually owes is 512,200 naira. See? Once you account for all your costs properly, the math at the end is really straightforward. Now, I've said the word allowable a few times, and honestly, this is probably the most important detail in this whole thing. You can't just subtract any old expense you've ever had. There are very specific rules about what the tax office will actually let you deduct. The logic here is actually pretty clear once you see it. On one side, you have your allowable costs. These are things that are directly for buying, improving, or selling the asset itself. Think legal fees, the cost of a new roof, or the ads you took out to sell it. On the other side, you've got costs that are not allowed. A perfect example is tenant rates. Why can't you deduct that? Because that's an expense for generating rental income, not an expense that adds to the capital value of the house itself. You can't double dip your tax deductions. So now that you've seen how every single naira you spend on buying and improving an asset can directly lower your final tax bill, I'll leave you with a question. The next time you buy a major asset, what becomes the single most important file you need to create and protect from day one? The answer could save you a whole lot of money.